What's up YouTube and welcome to a new video. Last year was a record-setting year for car prices as prices went up with 47%. So what does this mean for 2022? Will there be a market crash? Some experts are expecting a serious correction. Will prices remain flat or will they continue to soar? And what does this mean for you? Should you sell, buy or wait? That's what we will find out in this video. But we'll first look back at 2021 and especially the last quarter to see where prices are currently at. Cox Automotive namely updated all the 2021 data for the car market. Over here we can see the indexed long-term wholesale prices since 1995. Due to inflation you can see that the trend is upwards, but you can also see that there are some periods where prices increase more than the trend and periods where prices increase less. Look for example at 2008, the financial crisis. Last year is of course the big outlier. Prices dropped in the beginning of the pandemic as there was a lot of uncertainty, but they quickly recovered and surged to historic heights. Demand increased as people didn't like to use public transport and disposable income rose. At the same time, supply decreased following poor supply chain management and later the chip shortages. And all of this resulted in a price increase of 47% during 2021. But these are of course the wholesale prices, not the resale prices what you are paying as a consumer. So let's now zoom into last year and see what happened to retail prices. In the update what I showed you last quarter, we namely identified that dealers might have been overconfident and that people were simply no longer willing to pay the high prices. Let's see what happened. Over here we have now the weeks of the year on the horizontal axis and the price index on the vertical axis. You can also see that the grey line displays the wholesale prices and the blue one the retail prices. And we have these lines for both 2020 and 2021. Now then, as you can see from the beginning of this year and from last year, it's usually so that retail prices follow wholesale prices with a delay. You can see here that when the grey line went up, the blue line followed. Now we're not going to discuss all of the developments over here. I would like to focus on the last quarter of 2021. We namely identified in the previous video that wholesale prices were increasing rapidly and that retail prices were lagging behind. The gap between the two lines was very large going into Q4 and the question at the same time was if dealers were perhaps a bit too confident. Well, as you can see during the development of Q4, maybe they were. We can see that retail prices adjusted slightly to wholesale prices, but not with the speed that we saw in the beginning of the year. Retail prices were quite flat during December. Moreover, we can see that wholesale prices started to come down at the end of last year. In other words, it might be so that dealers are noticing that the elasticity is out of the price for now. But let's look a little bit deeper into this to see what's going on. Cox Automotive published a few underlying data points which help us to understand these developments. For the supply side, so for the wholesale prices, we can have a look at the sales conversion rate. The sales conversion rate shows the percentage of cars which are sold at auction and therefore is an indicator of dealer confidence. If a dealer thinks he will sell a lot of cars, he will buy many cars to maintain the inventory level. According to Cox Automotive, this is then also a leading indicator for the wholesale prices. Over here we have the development of the sales conversion rate for 2019, 2020 and 2021. The weeks of the year are again displayed on the horizontal axis and the rate itself on the vertical axis. At the end of Q3, the rate was with 66% far above what's typical for the time of the year. You can see that by looking at the 2019 level. So dealers were buying a high percentage of the cars. Now as we discussed in the previous video, this can either be because they were confident that they could sell them, or perhaps also to get enough inventory for tax refund season in 2022. However, all of this changed during Q4, as we can see that the rate fell back to normal levels, signaling a drop in dealer demand for cars. And this of course ties in nicely with the drop in wholesale prices, what we saw in the previous graph. But note that this doesn't mean that everything is back to normal. Commercial auction supply, so the cars available to dealers to buy from the auction, is still extremely low. Off-lease inflow is at 15% of its normal level and inflow from rental companies sits at 30% of its normal level. But let's go back now to the price graph. We just saw that the sales conversion rate decreased during Q4 and that this is in line with what happened with the wholesale prices. They also decreased. So what about the retail prices? Let's dive a little bit deeper into the demand side. Over here we have the retail sales for the new and used cars compared to 2019. The solid lines show the development for 2021 and the dotted faded ones for 2020. And remember that all of the lines show the development relative to 2019. We can see that since the spring of 2020, used and new retail sales decreased consistently and were below 2019 sales. Yet, in Q4 things stabilized a bit and the trend changed direction. We can see a flat development for both new and used sales and even an increase during December. Especially the increase for the new cars is interesting, as it might highlight that supply is creeping up, hereby preluding the end of the supply shortages. However, this doesn't mean that everybody is suddenly able to buy new vehicles. In relative terms, they are still extremely expensive. A quick look at the Vehicle Affordability Index, which shows the weeks of income needed to purchase a new vehicle, reveals that it sits at an all-time high. In other words, new car prices increased much more than the median income, meaning that you now need 43 weeks of income to purchase an average new car. And with that, I think it's time to go back to the price graph and summarize what we just saw. We saw that wholesale prices increased rapidly during the second half of 2022, and that this is fueled by dealer confidence or preparatory actions to build up enough stock for tax refund season. Nevertheless, the sales conversion rate for auction sales returned back to normal in December, and this resulted in a decrease in wholesale prices. In the meantime, retail prices adjusted only marginally to the increase in wholesale prices, signaling that the elasticity might be out of the price. And this is also supported by the used retail sales, which consistently dropped during the second half of the year, stabilized in Q4 and saw a slight increase during December. And all of these dynamics are beautifully reflected in the dealer's inventory levels. So let's have a look at those and then talk about what can happen in 2022. Over here we can see the new and used days supply, and this shows how long it takes on average for a dealer to sell its inventory. We have the weeks of the year on the horizontal axis and the development for 2019 in grey, 2020 in blue and 2021 in yellow. Let's start with the new days supply. We can see that this drastically decreased during 2021 and also sits far below 2019 levels. Also, we can see that since mid Q2 it didn't change significantly, showing that the situation for new cars isn't really improving. And this contrasts to what we can see in the used car market. Over there we can see an upward trend since Q1. Consequently, values in December are close to what they were in 2019, highlighting that used cars are, on average, no longer selling like hotcakes. And this of course might be the result of the price increases what we saw throughout the year. We already saw many signs that prices start to be overstretched, and this fits in nicely with that. So, to sum it up, the new car market is still out of balance, while the used car market starts to show sign of stabilization. Something which we didn't see for a long time. But what does all of this mean for 2022? Should we expect a continuation of this stabilization, or will there be a major price correction? Let's start with the forecast from the experts of Cox Automotive, who also compiled all of this data. They're expecting that used vehicles will drop by 3% during 2022, but they are not expecting a linear development. Rather, they are expecting a kind of U-shaped development. If we go back to the basics, then these prices are driven by demand and supply, which means that prices will only change when one of these factors change. Typically, demand for cars increases in spring season, which also means that with an equal supply level, prices will increase. This is then also why they are expecting a further increase in prices during the first half of 2022. After spring season though, demand typically drops, meaning that prices should stabilize again. However, mid-2022 is also when supply for new cars should start to recover. Moreover, it's likely that there will be some interest rate increases, hereby reducing demand. And with this increase in supply and decrease in demand, they are expecting prices to start decreasing in the second half of the year. For the full year though, the net effect is estimated to be only very small at 3%. Now as you just saw, there are many if-then statements included in the forecast. And typically, the more if-then statements in any forecast, the higher the uncertainty in that forecast. You are namely dealing with chances on top of chances. So let's also have a look at the second forecast, one made by KPMG. They are not so optimistic, as they indicate that used car prices could fall by 20 to 30%. They state that the relationship between new and used car prices is skewed right now, and that this relationship needs to be restored. Used car prices simply increased a lot more than new car prices, and this relationship needs to be corrected. But this doesn't necessarily mean that prices will go back to pre-pandemic levels, as new car prices can remain higher than before the pandemic, meaning that also used car prices will end up at a higher level. BMW and Daimler, for example, reported that they will keep prices high simply because they noticed that they can. Now, when it comes to the timing of the drop in used car prices, KPMG notes that this depends on the interaction between demand and supply. So far, nothing new. They, however, also provided illustrative examples as to how the new car shortage and therefore used car prices might develop under each one of the scenarios. Over here we have the 4 scenarios, with the time on the horizontal axis and the new car shortage on the vertical axis. You can see from the graph that in the longest possible time frame, with low supply and high demand, it could take until late 2023 before we get back to relatively normal used car prices. For all the scenarios, they by the way note that used car prices will start to come down before the shortage reaches zero, as the market anticipates this event. But this is an interesting result, right? KPMG seems to be relatively certain that there will be a decent correction in used car prices. It's just a matter of the height, timing and path of the correction. Now, if there would be indeed such a large correction in prices, it would also mean that there are serious consequences for the industry, but especially for us, the consumers. KPMG estimates that when supply and demand are again balanced, 30 to 40 million used cars will have sold to consumers at a 30% premium compared to pre-pandemic levels. So this means that when they trade in their car 2 to 3 years after their initial purchase, there will be very little or negative equity, which of course affects the next purchasing decision. So we just looked at 2 different forecasts, one from Cox Automotive and one from KPMG. One was predicting a small price drop of -3%, while the other one was predicting a more serious drop, ranging between 20 and 30%. But why do I think that will happen? Well, let me start by saying that all of these forecasts cover your everyday cars, and the people who made these forecasts have way more data at their disposal than I have. Yet, based on common sense, I have to agree to some extent with the view of KPMG that the relationship between used and new cars is out of sync and that this is likely to be corrected. But like I expressed before, I expect that this will be a gradual adjustment and that prices won't return to pre-pandemic levels, simply because new cars will be priced higher as manufacturers will try to create scarcity on purpose. So if you have a used car on tight financing which you bought after the price surge, it might be worthwhile to monitor things through 2022 and trade it in. The problem is of course that you still need a car. Yet, if you trade it in for a cheaper one, the absolute value decrease that car will experience will be a lot lower. After all, it makes a large difference if a $50,000 car loses 30% or a $15,000 car. On the other hand though, if you already have a car and need a new one, it might be worthwhile to try and postpone the purchase to avoid buying an overpriced car. But what about the more special cars that typically feature on this channel? It of course depends a lot on the specific model you are looking at. But in general, you can say that collectible car prices don't follow the used car prices. The underlying drivers which move the prices are then also completely different. We saw, for example, that 996 prices skyrocketed, but it doesn't make any sense to attribute this to the shortage of new cars. I don't think it's likely that the majority of people shopping for a 992 consider a 996 as an alternative when the 992 isn't available. No. The market is much more driven by emotion. Now, when it comes to the price trends in those markets, we saw in recent videos that after a severe increase, some of them start to flatten now. So especially for those cars which saw such an insane increase, I think it's likely that we can expect a more stable price period. Some might even experience a small price decrease. Yet, I think it's unlikely that we will see a serious correction of 20 to 30%, which was forecasted for the used car prices. The underlying price drivers are simply different. Moreover, the collectible car market is in a completely different spot compared to the normal used car market. The Haggerty Market Index shows, for example, that collectible cars came down significantly from their peaks in 2015 and only started to increase recently. It's not completely fair to compare this index to the used car price index what we just saw, as there are some methodological differences, but it gives you a rough view. If you, by the way, want to know more about the historical price development for collectible cars, then I recommend that you click right over here. Now, I have a feeling that this became quite a long video, so let's wrap up and conclude. We started by investigating the Q4 2021 data, and this showed that used car prices might be stabilizing following the severe price increases. The new car market is however still out of sync, as new day supply is extremely low. Now when it comes to 2022, we explored two different forecasts. One which predicted a 3% decrease and a more pessimistic one predicting a 20 to 30% decrease by 2020 or 2023. And especially in the latter scenario, there might be serious consequences attached, as people might end up with little or negative equity. So we also discussed some strategies to deal with it. It's however important to note that all of this goes for your everyday cars. I think it's unlikely that we will see such a large drop for the collectible car market. And with that, we arrived at the end of the video. Now if you enjoyed this video, please support the channel by clicking on the like button down below. Also remember to subscribe if you want to see more videos like this in the future. As always, thank you for watching, and I hope to see you next week for a new video.